Let's bring in Aadil Zaman, partner at Wall Street Group, Alliance Group. Aadil, good to have you here. Thank you so much for joining us. So let's dive right into the jobs numbers here. Coming out today, 500,000 is what economists are thinking here. What do you think that will signal if we get that number here about the labor market?
Always a pleasure to be with you, Baker. So, we feel that this is a very consequential report because this is the last piece of jobs data that the Federal Reserve is going to look at before the November meeting. And like you said, that 500,000 number will show enough improvement to justify a Fed tapering starting in November. So we feel that the more important item over here, Baker, is that this report is going to continue to improve month over month because, as we get further away from the bonus unemployment, and as that happens, the Federal Reserve will have no choice but to step in and start raising interest rates. So we are going to see ourselves in an environment where interest rates are relatively high, where we have relatively high inflation. And in that type of a sector, there are certain that type of an environment, there are certain sectors that outperform. And at Wall Street Alliance Group, those are the sectors that we are allocating our clients' assets to.
So let's talk here for a moment about the debt ceiling, because obviously everybody was under the assumption a deal was going to get done here. I mean, the idea of us defaulting on our debt is even just catastrophic to even think about. And almost every senator from Mitch McConnell to Joe Manchin said that they were going to get a deal done here. Now that the can has been kicked to December, is the expectation again that the U.S. is basically going to find some sort of deal to raise the debt ceiling again? And does that kind of change maybe your perspective in terms of the outlook of the markets for the next couple months because you don't have to worry about the debt ceiling debate anymore?
Baker, it's good news that it's pushed down the can, but again, like you said, it's pushed down the can. We could potentially find ourselves in the same mess again in December, right? So we feel that the shenanigans in Washington are going to continue, and that could be a potential catalyst for a correction in the market. I mean, if you look at the market, we have gone up in a straight line since March of 2020. I mean, stock market since March of 2020 has doubled, right, without any meaningful correction. And historically, we do get a correction in the market once a year, right, of around 10%. And that is long overdue. So we do feel that these issues, these shenanigans in Washington could have an impact on the stock market. It could create a correction in the market, which honestly, as far as the market is concerned, we would view a correction as healthy and as an opportunity since we are constructive on equities for the long term.
Yeah, that's a very good point because you're right. We really haven't had a correction in a while. If we did have a correction, and look, we might be on our way to it right now just based on how crazy September and October have been. Do you think it's because of the supply chain issues and maybe even the labor shortages that we've been experiencing right now as sort of the catalysts or the reason for a potential correction here?
Yeah, great point, Baker. So yeah, we do feel that the labor shortages and the supply chain issues are the dominant themes that are emerging as companies are reporting their earnings. I mean, if you look at the earnings of a company like FedEx, for example, it's quite obvious that they have to raise wages to attract workers to deliver, packages. If you look at the earnings of Nike, for example, it's taking them twice the amount of time that it took them before the pandemic to move goods from Asia to North America. In some cases, Baker, global shipping costs have quadrupled. So what happens is that when brands like this face higher costs, what do? They tend to pass them on to you and me in terms of higher prices. And when brands raise prices, they usually tend to be sticky. They go in one direction. So we get sticky inflation, and that could potentially be the catalyst that could cause the correction as well.
COVID numbers obviously down. We're now averaging less now than 100,000 new COVID cases a day. Offices are about to start opening here very, very soon as well. This gives everybody sort of the idea of, okay, what is sort of the reopening stocks or sectors that a lot of people are going to be paying attention to? Aadil, are there any in particular that you're watching for sort of reopening stocks or sectors in a way?
Yes. So, Baker, we are very constructive on energy. We do wealth management at Wall Street Alliance Group for a lot of physicians. So we get a bird's eye view of what the health situation is. And we are very encouraged by how the US is now finally getting a handle of COVID. Our population, through a combination of vaccination or contracting the virus or a combination of both is developing immunity, right? And as these COVID fears that you mentioned are subsiding, we feel that reopening sectors, in particular energy, is poised to do well. And we do agree with OPEC's outlook that the global demand for oil is going to exceed pre-pandemic levels in 2022. So we believe that this will positively impact some of the larger oil-producing companies that we are very constructive on.
What about tech in particular? Just because tech has really gone on a wild ride over the course of the last couple weeks. At one point earlier this week, Amazon was negative for the year, which is also a weird statement to even say. We've also seen Facebook fall, based on all the headaches that they're having right now on Capitol Hill and the whistleblower. Are you concerned at all about the tech sector for at least the rest of the year?
So the tech sector as a whole, the answer would be yes. Look at how much it has gone up. I mean, it has had an unprecedented run up. It could also get impacted, in addition to the issues that you mentioned, it could also get impacted by the slowing growth in China, right? Because a lot of these tech companies, their businesses are levered heavily to China. And also, if the House bill gets passed the way it is, these technology companies could face a proportionately higher tax on their foreign earnings, which could impact their overall earnings. So we do feel that technology could be positioned for a correction, and money could flow out of tech and move more into the value reopening sectors such as energies and financials. But again, don't get me wrong, long term, we are still very constructive on technology. But short term, a correction could happen there, and that too, as a long-term investor, we would view as an opportunity.
And what about retail? Is the expectation here that the holiday season is going to be great for the retail sector, at least for the rest of the year here?
I had just gone shopping the other day, and the salesperson told me that the buyer before me had just spent $6,000 purchasing clothes. The people have been deprived of being able to spend, and right now with personal savings so high, they are going to go out and they are going to spend, and so we feel that retail is positioned to do well going into the holiday season. However, there are going to be supply chain issues, which, Baker, honestly, we feel that it'll probably take about a year or so for them to even out. But companies that are able to manage the supply chain effectively, we feel that they will be positioned to do better than others going into the holiday season.
Well, whoever was buying the $6,000 worth of clothes before you clearly had a great shopping experience. Aadil Zaman, partner at Wall Street Alliance Group. Good to have you here, Aadil. Thank you so much for joining us.